This crash is not coming. It already started. This high is the trap. The people who bought it think they got saved. They did not. They told you the worst was over. They sold you this bounce as healing. It is not healing. It is the last bid this tape is going to give you. On March 30th, the NASDAQ undercut 20,690. That was the flush. The day they said the damage was done. From that low, this index ran. Not a bounce, a vertical bid. By June 1st, it printed 27,190, a 31% rip in 9 weeks, an all-time high. That is what a last rally looks like. Fast, crowded, sold to you as healing. Today, this index is still sitting about 2% under that high, close enough that the people who bought the rip still feel smart, close enough that every dip looks buyable. That is how you get trapped. The candle still looks fine. The story still sounds fine. The collapse has already started, just not on this candle. Look at the shape of that spring. A hard low, a straight line up, then a stall under the high. June 1st was the print. It has not broken out since. It is living under the high and calling that strength. Hesitation after a 31% rip is how last rallies die. They cannot save this with another green open. The people who have to spend money already voted. You just have not seen the ballot yet. I am going to put a second line on this chart. I am not going to name it yet. One line is at the high. The other line is in a hole it has never printed. These two used to move like they knew each other. When the second line broke, the first line used to follow. Not this year. This year, the first line made a new high while the second line made a new low. That is not a healthy market. That is a market pretending the crash is a future event when half of the picture is already there. By the time this high fails, the other line will have been screaming for months. They told you the worst was over because this tape went green. Green is not the same thing as repaired. Here is the line. This is the University of Michigan Consumer Sentiment Index. It has been asked every month since 1952. In May, it printed 44.8. That is the weakest reading in the history of the survey. Weaker than the bottom of the financial crisis. The crisis floor was 55.3. May went through it, not by a little, by more than 10 points. And while that print was hitting, this other line, the NASDAQ, was already turning up toward an all-time high. Households in the worst mood ever recorded. Risk assets at the most expensive level of the year. That is the split. That is what this title is actually about. The collapse started in the household. The index has not admitted it. Then they sold you the bounce. June came in at 49.5. July at 55.2. 2 months up. The worst was over. The shock was digested. You could go back to sleep. Hear what July actually was. 55.2 is not a recovery. It is the financial crisis floor. They celebrated a bounce that only made it back to 2008. Then they lost it. Watch August. Preliminary August, 51 even. Down about 8% in a month. The rebound failed. July looked like it was climbing back toward normal. It was not normal. It was the old crash line. August gave even that back. That is not a fresh crash call dated to next Tuesday. That is a failed bounce after a record low. And a failed bounce after a record low is how the next leg down starts in the thing that actually pays for this market. Look at what broke inside the survey. Views of personal finances only slipped a little. Expected business conditions fell 11% for the next year, 17% for the long run. People can live with an ugly present. They stop spending when the future just got rewritten. Year-ahead inflation expectations are 4.3%. Before the spring shock, they were 3.4. Only 8% of households think their income will outrun prices this year. 8%. That is not a soft landing in anyone's kitchen. That is a country that does not believe a raise will catch the bill. Put 2008 on this chart. In the financial crisis, this survey bottomed at 55.3. The stock market did not bottom on the same day. It lagged, it denied, then it paid. Today, the survey is worse than that floor.
Even the July recovery only tied it. Then August broke below it again. The stock market is not worse. It is near a high. That gap is the entire story. Either the household was wrong and this high is earned, or the household already printed the crash and this high is the last bid. I am not going to date the second one for you. I am going to show you what to watch so you can see which way the gap closes. The first lie is, sentiment does not matter because the market is up.
The market is a price. Sentiment is whether the people who buy goods still believe next year works. This market runs on those people. If they are at a record low and the bounce already failed, the market is up is not a rebuttal. It is the trap. The second lie is, this is just politics. The survey has lived through elections, wars, oil shocks, and 2008. It has never printed 44.8. Politics does not get you a 70-year low by itself. The third lie is, August is noise. 1 month can be noise. A record low, a 2-month bounce, and an 8% reversal is a pattern. That pattern is a failed rebound. 3 things. 1. The final August sentiment print at the end of the month. If it holds near 51, the rebound is dead. If it collapses back toward 45, the household is still in freefall. If it reclaims July's 55, the failed bounce thesis is wrong. That is the invalidation. 2. This NASDAQ high, 27,190. As long as this tape lives under that high and treats it as a ceiling, the last rally is a top, not a breakout. If this index loses the spring structure and starts treating 20,690 as a magnet, the tape is finally agreeing with the household. 3. Inflation expectations. If the 1 year stays stuck near 4.3, while the household mood cannot hold a bounce, this split does not heal. It hardens. This is not a trade. It is a map. The collapse the title promised is not a red candle on June 1st. June 1st was the high. The collapse is the gap. A household at a 70-year low. A failed August rebound. An index that still thinks the worst is over. When these two lines close, they will not close quietly. The market can keep running on this. When these two lines reverse, it will not.